As we've been telling you, Wall Street firms issued loans to help finance all those drilling projects. And now we know which financial institutions have the biggest exposure. Kayla Tausche has more.
The S&P financial sector has fared nearly as badly this year as the energy sector because it's almost as directly affected by the price of oil. And that correlation plays out in two specific ways. First, as stress in the oil market continues hurting global growth, the Federal Reserve is faced with a tougher case to raise rates this year, and that was supposed to be the big benefit to bank stocks. Then banks chased the energy boom for the last several years, loading debt onto companies trying to drill for oil and gas. Lower prices mean less profits for those companies, and they're less able to pay their debts. And those debts are what investors are most interested in, and why executives have gone to great lengths to lay out exactly by how much they're at risk. Goldman Sachs on today's earnings call said it has $10.5 billion in direct exposure. Bank of America and Citigroup have north of $20 billion, Wells Fargo $17 billion, JP Morgan $14 billion. Morgan Stanley's is $5 billion, but for that bank, it's the biggest share of its overall lending. More important, though, is how much the banks are setting aside should a portion of those portfolios go belly up. According to an analyst at Goldman Sachs, Wells Fargo is setting aside the most, Bank of America the least. And even though all of these banks have different size portfolios, different types of risk, they all say if oil continues to stay low, their costs will only go one direction, and that is up. For Nightly Business Report, I'm Kayla Tausche in New York.